Hey, Saretsky here. Welcome back to the show. Want to put this video together to basically round out the summer, the last weekend as we head into Labor Day, as we head into September, and the importance of the September housing market. So, for anyone that's following the housing activity across this country, keep an eye on September. I'm going to get to all of that and the importance of the September housing market, which all correlates to what we're going to talk about this week, which is Canada's GDP, jobs data, construction activity in this country and how that's filtering through ultimately into the bond market and your mortgage rates. The Bank of Canada, of course, is on deck in September. So we're going to walk you through all of that this week. But we get to start off first and foremost with Canada's GDP. What is happening in the economy today? We know that the economy basically stalled at the onset of the tariff announcements. Basically, everybody is frozen solid, not able to basically make business decisions or large house decisions, and that effectively has frozen activity. You can see that in Canada's Q2 GDP down 1.6% annualized, a 27% decline in exports. So a sharpest decline in GDP outside the pandemic since I think 2019. So again, really a red flag on the trajectory moving forward of the Canadian economy. It's something to kind of keep a close eye on. And this is ultimately bleeding into the labor market. We know this. We've known this for quite some time, despite the volatility in stats cans, job and labor numbers. We know that whether you look at some of the data or you look at even the anecdotes, we know that youth unemployment's running at 20-year highs. We know that there's just a lot more people losing their jobs and just slack in the labor market. Wage growth running at levels last seen in 2016. So you're seeing some softness in wage growth. But if you look at what's happening in the labor market, per National Bank, only 36% of private sector industries have grown jobs over the past 6 months, which they say, quote, is unheard of outside of a recession. So again, you could argue whether or not we are in a recession or not. I would argue that we're already in one, and the jobs and the data will all be revised, 3, 6, 9, 12 months from now, as it typically is. That there is a real softness in the Canadian economy, in the labor market. In the labor market, particularly looking at what is the trajectory moving forward. And again, I continue to flag, I think the biggest red flag moving forward is the weakness in the new construction market. When people talk about the weakness in the housing market, are all these segments and pockets. And I say, listen, guys, the real fireworks, the thing to actually keep a close eye on, the real carnage and damage and activity to keep a close eye on is what's happening in the construction sector, the new construction sector. If you look at our largest major metro in this country, in the GTA, we just had the July data that just came out. Total home sales, there's 359 new home sales in July. Guys, this is a metro region with nearly 7 million people. You had 359 new home sales year to date. We're at 2,600 home sales throughout this entire year in the entire GTA region. When back during the boom of 2022, we would have been roughly at about 25 to 30,000. So you're at 2,600. 2,600. The collapse is evident in the construction space. And this is from the construction industry, the developer industry, basically saying, quote, what more evidence is needed to demonstrate that we need concerted action to address the crisis that is stalling out new supply and compounding the challenges in the GTA housing market, says the BILD build group, basically saying emerging from the 1990s downturn took years of prolonged negative economic impacts and unemployment in the sector. The market, leaders of the industry, and top economists are flashing every possible warning light. And the lesson from the 1990s downturn is clear. If government stands by, the pain will be deep and prolonged. To avoid repeating history, government intervention is not optional. It is urgently due. Again, keep in mind, we had just over 2,000 home sales in the entire GTA region so far this year. So there is nothing transacting or trading in Canada's largest construction sector in Canada. You look at Vancouver, it's a similar story. We're seeing a lot of the same problems. We're seeing some of the largest developers continue, some of them in large liquidity issues. I won't name names, but they are quite obvious liquidity issues, selling of assets. We are seeing the basically what you're seeing is, a give you an example. In let's say Burnaby, Brentwood, you could pick up like a two-bedroom condo that's 3 or 4 years old for about $1,000 a square foot. So 3 or 4 years old, it's effectively brand new. You actually don't have to pay GST, so there's a bonus. So it's 3 or 4 years old, basically brand new. Sells at about $1,000 a foot today. And you're seeing developers now trying to launch and have available new construction inventory that's around 1,300 a foot. So you have this huge delta, right? I mean, this huge delta between 1,000 a foot and 1,300 a foot. So you say, well, the developer, I mean, greedy developers just cut his price, guys. I mean, if you're a developer and you cut your price from say 1,300 a foot to 1,100 a foot, I mean, you're wiped out. I mean, you do that across, you know, 20-30% of the building. I mean, you're done. So like there's not really an ability necessarily in many cases, not all cases, but in many cases, there's some ability to move prices, you know, maybe from 1,300 to say 1,200 a foot. That's going to be very painful, but you can't just take it from 1,300 to 1,100. And that's why I say the biggest problem is in the new construction space, because there's less ability, I should say, to move with the market. And what we're seeing in the market today is and we've talked about it on this show for the last several weeks, is you're seeing an acceleration in housing activity nationally for the last 3 consecutive months. I actually think it's 4 consecutive months now. You've seen an uptick in housing activity. Why are you seeing an uptick in housing activity? Because the prices are adjusting. The prices are coming down in the resale market, and they're coming down rather quickly. Finally, it took a long time. It's kind of been like this slow grind, slow process. But as the inventory has built, people have finally said, you know, I need to sell. I want to move on with my life for various reasons. And the prices are coming down, and that is resulting in the uptick in activity. So the resale market is moving and adjusting rather quickly, but the developers are obviously typically very reluctant to reduce prices, and they are not able to keep up with the changing market conditions. And so this is where I say, okay, at the start of the video, I said, pay attention to September. September is really important. September is really important. Why is it important? Because there's seasonal fluctuations to the housing market. Seasonally, the fall market, September, October, you'll see an uptick in activity. You'll see more sales, you'll see more listings, you will see just a lot more transactions. And I think what you're going to see is, if you're a home seller, and we have some of them where we're trying to now reposition them. So guys, listen, you didn't sell in the summer. It is now time to readjust. If you want to sell, if you are committed to selling, you take this thing off the market, you let it breathe for a couple of weeks, because nothing is happening over the Labor Day long weekend of the dog days of August at the end of summer. You wait until basically post Labor Day, mid-September, the housing market will restart, and you will have a fairly active housing market from basically mid-September till the end of October. That is the seasonal fluctuation in the housing market. And so if you are committed to selling, you have effectively a 6 or 7 week window here to basically penetrate that 7 week period and actually move. Again, if you're not that motivated to sell, then maybe you just sit on your price. But if you want to sell, you take it off, you readjust, reposition the listing, and you get more realistic and more competitive with the pricing. Now, obviously, there is a cohort of sellers that are stubborn, that will anchor bias. They'll say, Steve, but listen, we're this talk of more Bank of Canada rate cuts. In fact, after this horrible GDP data, the market odds of a BOC rate cut went up to 50%. 50%. So we're at effectively a coin toss for the Bank of Canada to cut in September. But again, it's just a coin toss. And you have to ask yourself, if the Bank of Canada is cutting in September, what does that tell you? Probably tells you the economy is pretty much as bad as we believe it to be, or the Bank of Canada is worried about where the economy is going or where the labor market is at. They would be trying to sort of get out in front of it. So it's like, is a 25 basis point cut going to improve your price. I mean, it could spur more housing activity, more sales, but I mean, is it going to improve the price? I mean, real estate prices don't fluctuate immediately. You don't go from like prices declining to back up. I mean, so like, I think the reality is if people are realistic with selling, you have a 6 to 7 week period where if you're going to sell, this is probably the most likely time to do it. Otherwise, you're probably your next real opportunity where potentially market conditions could be different for better or for worse. Market conditions could be different, will be basically in the next spring market. And that would be effectively starting kind of mid to late February is the start of next spring market. And so effectively, it's kind of like it's basically now or never. And so, like I said, what we're seeing is prices gapping down. Finally, sellers have adjusted. That's why you're seeing the uptick in activity. And this all correlates to what we're seeing playing out. A couple other notes: the bond market reacting to some of the GDP numbers. I think the 5-year bond yield was down about 5 basis points. So again, mortgage rates is still on the fixed side, still effectively stable and flat. Most people today are borrowing at about 4%, 4.1, 4.2. Renewals coming in a bit lower than that. The BC government, where I am here, the BC government announced they are capping rents as they do every year. Rents will be capped at 2.3%. So again, if you're a landlord today and you got a tenant that's below market, you want to raise the rent on them, you can only raise it by 2.3%. So again, people that are, let's say, cash flow negative and have an existing tenant that's below market, probably not going to do a lot of favors for you at 2.3%. But as we've said, turnover rents, which is when units turn over, we're seeing basically have peaked. We all know peaked about 18 months ago in places like Vancouver, Toronto, and you're seeing those double-digit declines. And they also now emanating in places like Calgary as well. So there's a lot to sort of navigate. Markets are really going to pick up, not just real estate, but I'm talking financial markets. You're going to get a lot of new data points coming in, a lot of central banks active. And again, that is all going to start in September. So take this video as sort of the precursor to align yourself, whether you're a buyer or a seller. If you're a buyer, you're going to see a lot of listings that were listed in the summer that are going to come back on in the fall. You're going to see more new listings as well coming to market. So the inventory levels should be well supplied. There should be deals and discounting. Again, so specifically in certain segments of the market, and I'm looking at some of the new construction stuff where some developers are going to have to move units. I'm looking at a lot of investor style condos, sort of the pockets that we know that have been weak. There is price discounting, and there's going to be some opportunities in that space. So as always, guys, we'll continue to monitor the market. I hope that helped, and we'll see you next week.